Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklow.
And I'm Alex Collins.
And on today's episode, we're going to be talking about your net after-tax rate of return.
Yeah. And we're going to be focusing on the taxation component of that. There's a lot to chew on there. Today, the goal is just to understand the taxation component and how much that can actually take away from a return over a long period of time. And then kind of preview for next time, we're going to dig into okay, now that we know that, what can we do with that information?
Absolutely. So before we dive in here, Mr. Collins, let's talk about what we're drinking today.
So going back to one of our favorite breweries, Black Raven, this is the Men's Room IPA. I've not had this before.
I had it the other day when I was there. So I am drinking Scuttlebutt Brewing Company. I'm drinking their Amber Ale. They're based out of Everett. I don't know. Amber ales are always a solid one for me to have. What's your thoughts on the Men's Room, though? I'm interested.
I haven't tried it yet.
Amber. I haven't had this one in a while. This is a pretty solid amber.
It is. No, Scuttlebutt's a good brewery, and their amber is one of my favorite beers that they make. This is solid. It's definitely an IPA. It's a little bit more hops than what we've been drinking recently. But no, this is good.
Yeah, definitely try them out. I think we have Black Raven beers on our podcast more than any other brewery. There's a reason for that. They're just a solid brewery. So
it's one of our favorite breweries, and it's super local to us. This one clocks in at 5.8. It's got a boatload of hops in it.
Yeah, so definitely try them out. You've got Scuttlebutt Brewing Company out of Everett, and you've got Black Raven out of, I guess their brewery's technically in Woodinville now. So
yeah, Woodinville, Redmond, they've got tasting rooms in both places.
So let's dive into it. So for those of you listening, you might want to go and check out the YouTube channel for this, because we are going to have a visual aspect to this that I think is quite powerful. We're going to do our best to describe what we're seeing here, but definitely check that out. So Alex, without further ado here, let me share my screen. So what Alex and I were discussing prior to hopping on here is, most people, they're contributing to some investment, right? And that investment ideally is growing. And, a lot of times the conversations that people like to have tends to be around the rate of return aspect of how their investments are doing. And what they don't look at.
Full disclosure, Kyle and Jennifer Abernathy, the folks that are listed here, it's a fictitious client. We're not sharing client information here. This is for illustrative purposes only.
Yes, thank you for the disclosure and compliance message, Mr. Collins.
Yeah, you're welcome.
So again, we're looking at a portfolio here. It's a 30-year time horizon. It started in 19, and then we're looking at a 75-25 portfolio. So 75% equity, 25% bonds. Okay. And so we're going to look at this. And what we did was we put a 15% tax rate on this. So you can look at this from an effective tax rate of 15% or long-term capital gains tax of 15%, however you want to look at it. The tax is at 15%. And what we're going to show is the gross number, what this would grow to. And then we're going to show the net number in terms of once you take taxes out of the equation, what is the actual net growth of this asset. And the purpose of this is, too often we have conversations with people and they're like, oh, I got a 15% rate of return or 12%, whatever rate of return number they throw out there. And we have to then, going back to thinking with the end in mind, what's the purpose of our assets? The purpose of the assets is most likely to either pass down to our family or turn on an income stream to ourselves so we can live our life, or some combination of the two. And most of us, we have to live off the net number, not the gross number.
100% there, Ryan. And the other component that we need to take into account is so many people are like, oh, well, I didn't pull it out of my account, therefore I didn't pay taxes on it. And it's like, well, you did get a 1099 from the investment company. And so while you may not have pulled the dollars directly out of your investment account, and so you might wind up with the gross rate of return in the account, the difference could have been reinvested had you not had to pay taxes on it. And so the difference, whether you pull it out of the investment account or not, is real. we're just paying for it. We may not even be realizing we're paying for it. And the other component to this is like, hey, if we're paying it, pulling it out of the investment account, we might not get cap gains tax treatment with all of this, and so we might wind up with a higher taxation number if we're taxed at our marginal ordinary income rate as well on a portion of it.
So let's dive into this, Alex. So I'm going to hit the charts button here. And so what we're about to show you, I just cheated a little bit here. So let's take this out. So what we're about to show you here is in a 30-year time horizon, again, $30,000 contribution every single year from 1974 all the way out to, what is this, 2003. What this money would grow to pre-tax is $7.9 million, right? So it's a 75-25 allocation, like we said, 75% stocks, 25% bonds. This is what those will do. I'm quite sure that most people are looking at this and saying, wow, that's looking really good.
Yeah, I mean, we put in $930,000 a year times 30 years, and we come out with nearly $8 million. Like that's a win.
But what's the gross number? Right? Or what's the net number? I apologize. We're talking about the gross number. So what's the net number? Once we take into consideration taxes, and again, this is just 15%. Like we didn't go crazy on taxes, which sometimes you hear people out there talking and they're like, this is a 40% tax rate. Like we're keeping this ultra simplistic and realistic. And when we look at now the net number, we go down here to the lighter blue line, 5.3 million is the net number. Let me go back up here again. 7.9 gross after tax is $2.6 million difference. So this whole like, what's the biggest cost in life in terms of growing assets? Like you can make a strong argument that taxes are pretty strong.
Well, I mean, so that's losing approximately a third of the portfolio to taxes, even though taxes were only 15%.
And this is kind of setting us up for our next episode, but I do want to put the carrot out there right now. For those of you thinking, okay, well, I'm not paying taxes on my money in my retirement account. So, maybe that number is 7.9. Okay. So you're going to pay the taxes out if this is a pre-tax, traditional 401k or traditional IRA. When you retire and you pass the age of 59 and a half, and you start to pull this money out, at what tax rate are you going to be at?
It's still going to come out at ordinary income. And
we're still showing, again, this is the 15%. Like, is that accurate for you? We have no idea, but I'm just looking at it just from an asset standpoint. If you're steady Eddie and you're going to be in the 15% effective tax bracket in retirement, that still means that of the 7, you only own 5.3 of it.
Well, and here's the thing, Ryan. If we're talking about a married filing jointly couple in 2020, they moved from the 12% bracket to the 22% bracket at roughly $90,000.
Yeah.
So if you wind up in a circumstance, in a situation where you don't have, like, your income is going to drop below $90,000, like, okay, maybe ordinary income is totally fine and that's going to wind up being a win. Most of our clients, we don't wind up seeing this massive drop in income. Most of our clients are making in the neighborhood of 200 to 500, maybe $1 million of cash flow, especially the years leading up to retirement. And they're not going to want to take to a person. None of them have said, I'm willing to go ahead and now make $90,000 a year of cash of taxable income.
Right.
So as a result, it is a massive, massive shift in order to go ahead and accomplish what you just talked about. So reality is, if we're talking about ordinary income, we're probably talking about an even bigger drop than the 15% taxes. We're talking about a much, much bigger impact. So
when we talk about that impact, like we've said this, I don't even know how many times at this point, Alex, but the reason we're talking about this today is making sure you're taking into one other variable into account when you're looking at your rate of return, and specifically the end in mind is what are the taxation of your assets today as it's growing, as well as what's the taxation of it as you start to distribute it to yourself or pass it down to your loved ones. And you're making those choices today. That graph we just showed was $30,000 of contribution. $30,000 doesn't all have to go into one account. Right? So we want to look at it from the standpoint of where are we putting on the balance sheet? How much should go towards savings, investment accounts, retirement accounts, traditional and Roth, right? How much money should be going towards the insurance and the protection of your income? How much money should be going towards paying down the debt? You're making all of those decisions today. Today's conversation is more focused on taxes, and it's a big piece. And most people are not looking at it from that holistic point of view.
Well, and here's something else to think about and chew on. Like, okay, when we put together an exercise plan or a diet or any type of thing, how often is putting 100% of our effort into one exercise or one type of food or one anything is ever the best solution?
It's never.
Ever. Right? That's one of the few times we get to say it is never the most efficient way of doing this. We have to create some amount of balance. Balance doesn't mean equal parts into each one of these things, but we're going to want to create some amount of dollars into Roth, traditional brokerage accounts, like all of these various savings accounts, all these various different structures. So we've got money in the market, we've got money out of the market, we've got money in promise-based assets versus market-based assets, and we're diversifying the tax structure of our accounts as well. Now, the goal is not to overcomplicate the stuff and still keep it easy to understand. And we'll dive into some of that next week.
Yeah. So here's a quick teaser, right? So let's just say you're making, again, today's episode is focused on taxation. So we're going to look at income, right? So if you're making $250,000 today, right, and all of that is taxable, you fall into an effective tax rate of 18.43%, right? And by the way, if you want to know marginal versus effective tax rates, make sure you go check out that episode. We have a whole episode on that we just recorded. So make sure you go check that out. But again, this is $46,000 in taxes. What if when you get to retirement, you can look something like this? You still have $250,000 of gross money, but let's just say only 200 of it is taxable. You're down to a 13% effective rate. You saved $12,000 per year, right? That's a 26% difference in taxes in that strategy. And the only way to do these types of strategies that we're showing is making sure that you've got money in different buckets so you can actually have some sense of control over your tax rate, which we're going to talk about more in the next episode. So make sure you tune in for that.
Well, and Ryan, do me a quick favor. One of the things that good advisors like ourselves are able to routinely do is we're able to find a distribution strategy that actually creates slightly more cash flow. So change the 250 up to 300 and keep the taxable portion at 200. This is the situation where if we're able to go ahead and increase the amount of cash flow and decrease the amount of it that's subject to taxes, now this is a huge win on both sides, because now in this circumstance, we're still in the 22% marginal tax brackets. We actually came down a little bit, and we changed the effective rate all the way down to 11 and change, simply by increasing the amount of cash flow that comes in and decreasing the amount of it that is subject to taxes. And a lot of people would say, oh, well, that's voodoo. And the answer is no, it's not. There are distribution strategies that we can go ahead and employ that will increase the amount of cash flow that we have and decrease the amount of it that's taxable. And if you have questions on that, make sure that whether it's us or somebody like us, sit down with a professional and make sure that you're asking those questions of how do I increase my cash flow in retirement while decreasing my taxation.
Yeah, so make sure to check that out. Again, the next episode, we're going to dive more into this. Today's episode was more about, when you're looking at the rate of return, are you actually considering like what's the taxation of that money today and in the future? Which takes us to the question of the day, which we didn't prepare for, Alex.
Well, our question of the day is what I just proposed, is what is it that you're doing to go ahead and increase your cash flow in retirement while decreasing your taxation in retirement?
So head over to beerandmoney.net. At the top of the page is a contact us page. If you have any questions, or if you even want to answer that question, we'd love to hear like how is it you're analyzing what we're talking about today. It's a great spot to reach out to us. If you want more on taxes, again, go to beerandmoney.net. We've done several episodes talking about taxation. So there's a search feature at the top there, and just type in marginal and effective taxes, and there's a whole episode on that, and you can see that live. We hope this episode was valuable for you. And as always, Mr. Collins.
Cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities LLC, OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklow, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806. Pinpoint number 2024-174546, expiration May 2026.